we normally see he appear on different business channels as well. Presently, he is heading at Profit Mart Research Advisory Desk. So, with this, I would request Avinash ji if he would like to tell more about himself, and then we will proceed with the thing.
Yeah, I think good evening, everybody, and thank you for attending this Twitter Space podcast. In fact, my introduction has already been given. Just to add, I've been on the fundamental side since 1992, and till date, I've been covering many sectors, many companies. So my job is very interesting. In fact, the interest in my job only keeps me, working hard in this area, because today we are seeing many important, new companies coming to the capital market, some new sectors getting introduced to investors. So it's always a learning experience to know what is the company's business model, what is the management bandwidth, and I think, very frankly, data points which come, from the company side in terms of their balance sheet, in terms of their cash flows, every number tells a story to the investor, and I think we need to understand that very clearly. So data is very important. And secondly, on the qualitative side, I make it a habit to actually visit companies, talk to companies on virtual meets or either personal meetings, because that is also one important parameter when you look at fundamental research. So today a lot of data is available on Twitter, on LinkedIn, or typically on WhatsApp groups, Telegram channels. But I think what is important is that you require authenticity of that data, because today you cannot just use secondary data to take any investment call. So, I would definitely make a very, strong effort to ensure that everybody's questions today in the Q&A session are going to be answered. But before that, I would like to, give a small backdrop as to why, which sectors are important, which are going to do well, and what are the kind of key, data points as far as India is concerned. Because, if you look at our country, I think India is a country where you're going to see phenomenal growth for the next 10, 20 years. And before that, after that, of course, we'll take all the sectors which I like, and of course sectors which are to be avoided also, because it goes without saying that what you should not do is even more important than what you should do. So I think I've given my introduction and the flow in which I would begin. So you can tell me when we can start.
Yeah, that's great. So, Ravi, would you like to start with the questions? Then we move on to.
No, I guess Avinash had started on a very right flow. First thing, everyone would like to know what are the good sectors for next 20 years, few sectors which he can talk in detail, and what are the things to avoid. I think that would be the best thing to start off with. Sir, over to you.
Yeah, okay. I think Ravi, thank you for that. So friends, first of all, a very simple thing in the markets which I have learned the hard way is that creating wealth in the markets, from equity investments is not an easy job. We normally see television channels, we see a lot of experts come on channels and feel that it's a very easy job to make money. It is not. And time alone is going to actually train all of us, how many times we fall down and get up. So making wealth in the markets will only be possible as long as you love the journey of remaining invested in equity markets for the longer term. And only when you have a strong level of conviction is when actually wealth creation happens for you at an individual level. So you should not get frustrated if you find that stocks are not working out for you in the very short term, because equity is a long term asset class. Secondly, now coming straight away to the valuations of the market, the broad market according to me looks very attractive, because despite the fact that after the COVID pandemic, this year started with a very bad note. The Russia Ukraine war started, then we had inflation fears, commodity prices went up. But just to tell you what are the key, P multiples which are currently prevailing for the Nifty 50, I think the current valuation multiple is around 19 to 20 times based on 1 year forward earnings. And if you look at, the December 2019 kind of multiple for Nifty 50, it was almost 28 times. So we are still below that peak P multiple. As far as the Nifty Mid Cap 100 is concerned, we did a little research there also. There also we found that the P multiple in December 2019 was almost 25, 26 times. Currently, it is about 21 times. So clearly, I don't think markets are in a overblown bubble kind of territory. So there's obviously going to be a pick and choose approach which has got to be followed. But again, on a broader index level, I think markets definitely look to be fairly, reasonably valued. For the country as a whole, I think the key triggers which we are seeing in the last few months is, first is, our GDP forecast this year is going to be very solid. compared to all the developing countries, the developed world, our GDP would be about 8% for 22-23. And the GST collection has been improving and going from strength to strength. Now, this is a very important variable for all of us who track corporates. I think GST numbers for April 22 have touched an all-time record high of almost 1,67,000 plus crores. And most importantly, bank credit, which was roughly in the range of 4 to 5% in 2021, has improved to almost 10% in FY22. Now, this is a clear signal that credit growth is picking up, and this is probably a very good time for banking as well as for housing finance companies and for all the financials, basically, which we'll talk later in the session today. Most importantly, exports have also risen. We have seen a very strong growth in exports in the month of April 22. So that gives me comfort that the economy is on the right footing, despite the fact that inflation has increased. Commodity prices have gone up, and most importantly, now India is a market which we cannot. I mean, the global investors cannot ignore. Of course, FIs have been selling quite significantly, but on the global footprint, I think things like Jandhan, or for that reason UPI, Aadhaar, or maybe the vaccination program which took place post COVID, I think has been one of the biggest achievements for India. Which places us on a very strong competitive footing in the global markets. Our belief is that sector themes which will be really important going forward will revolve around three, four key parameters which I normally look in companies. And basically, first is the demography, second is the deleveraging, and third is the digitization. Now, these are three themes which are going to play out very strongly over the next 5 to 10 years. Demography has already been understood. Deleveraging is one area where I think a lot of effort has gone by corporates in reducing debt on the corporate balance sheets. And obviously, digitization is here to stay. After COVID, what we have seen is that digitization has actually taken off in a significant manner. And most importantly, in short, I would like to say that roti, kapda, makan, dawai, and suraksha. These are themes which are not going to go out of fashion. They are always going to give you decent amount of risk rewards in all markets, especially in volatile markets like now. So now coming to the sectors, without wasting time. Now the first sector which I like and where we have been advising some of our clients as well as telling some of our friends is basically the agri input kind of sector. Basically sectors covering fertilizers, seeds, agrochemicals. Now the reason why we have been talking about this sector in media as well as doing our own research is that we feel that you know due to the Russia-Ukraine war, geopolitically conditions are very bad for the food grain kind of scenario. In fact, we could see a huge food grain crisis emerging not only abroad, especially where obviously countries like Ukraine and Russia is concerned, but this is going to actually help companies which are going to get involved in the manufacture of food grain. So obviously companies which are into fertilizers, into seeds, in pesticides, and which have got a decent export market share will obviously benefit significantly. And secondly, I think a recent news report which I read just a couple of days back was that the Bank of England governor has said that there's a very big kind of a food shortage looming for countries like Ukraine, Russia, and the European markets. Ukraine is a very large supplier of wheat. In fact, it's among the top 5 global exporters for many agriculture products like corn, wheat, barley. So this is going to create a lot of issue as far as the food supply in the country in these countries is concerned. So typically, agri-related companies, companies like say a Sharda Cropchem or maybe a United Phosphorus or typically even a rallies. I would believe that one has to, of course, do a pick and choose here. But there are many companies which have got a good export kind of market abroad, and this is definitely going to help these companies. The second sector, which I think is going to remain very strong in the near term, at least for the next 3 to 4 years, is the defense sector. Now, defense sector is a very large domestic market opportunity. Clearly, it's a Make in India initiative. Mr. Modi has put in a lot of efforts, and now we are seeing that almost every defense company has got an order book of at least 2 to 3 years. We have seen very tepid results, for companies like Bharat Electronics or for that reason Bharat Dynamics, HAL. But typically these companies operate, in basically in not in a secular kind of growth patterns. Their growth is typically lumpy. So in one quarter you could see profits, in the second quarter you could find the profits are flat. But what is important is that you're going to see a lot of action in several defense companies because a lot of new defense items are now been privatized. A lot of private sector companies are now going to be given preference over the foreign companies. So here, I think this is one space where any weakness in the market, if it comes at all, I think one should use it as a good opportunity to accumulate these companies, if one has a long-term view. And the third sector, which is very important, which is not, company specific, but, it is basically for those companies which actually manufacture import substitute products. Now we know there are many import substitute products which are still imported because those products are not manufactured in India. Now, if you look at products like phenol, acetone, titanium dioxide, or for that reason TCCA or epichlorohydrin, these are products which are made by a handful of Indian companies, and these companies are going to benefit significantly because obviously being an import substitute gives them a decent amount of kind of margin, kind of protection. At the same time, demand is quite strong. So obviously, over the next say 3 to 4 years, our sense is that companies which are into these kind of import substitute products and where there is no local competition, you're going to see a lot of growth for these companies. So typically focus on import substitute products, and where largely the product is either made for domestic markets or even exported to some Asian or European markets. And typical examples could be a make money fine chem who's going to make basically epichlorohydrin, then titanium dioxide, again, which is used in the paint plastic sector in a big way. Almost 80% of that product is imported in India, and where Megmani Organics is setting up a large capacity. As far as phenol acetone is concerned, Deepak Nitrite continues to enjoy a very good margin advantage over the global, kind of peers. And as far as TCCA is concerned, I think Podal Chemicals is a very important player here. It's the only player in India, and globally also it's one of the few players which is now making TCCA, which has also got a very immense kind of potential. So import substitute theme will continue to do well, according to me, in the next say 2 to 3 years. And then we come to another interesting segment, which is shipping and logistics. Now recently we have seen a lot of fourth quarter numbers coming out, and I was brilliantly surprised that we saw very strong numbers from a lot of logistic companies like typically Al Cargo, TCI Express, or for that reason Shreyas Shipping, Lancer Containers. Now these companies have benefited largely because manufacturing sector has taken off in a very big way. There has been a strong uptake in global demand. There has been a rise in exports, imports, and this has actually helped the volume growth kick in very strongly. So typically, logistics is one space which had underperformed for a long time, but frankly, now looking at the numbers, I feel that there's a lot of steam left in these companies as far as the earnings growth is concerned. And if the economy grows by 7-8% for the next say 2 to 3 years, I would be reasonably sure that these companies would definitely deliver very strong returns going forward. The next sector is power generation, power distribution, and even power platform companies. Here the bigger story is that the power generation companies are going to obviously do well because power consumption levels have gone up. Power tariffs have also started, going up. In fact, there have been some concerted government support, for increasing the tariff. So, traditional power generators like NTPC, Tata Power, Torrent Power, other green players, renewable energy players will also do well. But I think companies like Tata Power, which is planning a strategic move to electric vehicle infrastructure, solar, I think this is one area where if one takes a 2 to 3 year call, then I think there's going to be a lot of growth here. As far as platform companies like IEX are concerned, power financing companies like REC are concerned, I would believe that these balance sheets of these companies are extremely strong, despite the fact that there could be some sort of underperformance in the short term. Longer term, I think investors will definitely make money. So we are positive on this sector also. And then finally, coming to the last 2 3 sectors. First is we are bullish on all the export oriented sectors which actually are earning dollars for themselves, because a weak rupee and a rising dollar is an excellent combination for such kind of sectors, especially companies from the IT space, from the pharmaceutical space, from the auto component space, from the textile space. So these are all ancillary sectors which are export focused, and obviously a weak rupee and a strong dollar is going to actually benefit them in terms of margins. Most importantly, here within the IT pack, just today I was reading some article where Prime Minister Modi has actually inaugurated the Bharat Drone Mahotsav today, and this was the first day where almost 200 drone manufacturers have displayed their products. So within the IT space, I think now all of us have to keep a very close watch on the drone companies, which are going to make drones, as the government is very, very clear that they see a lot of scope for these companies going forward. In fact, the government has very clearly mentioned, from Mr. Modi's speech, which I heard today, that the agriculture sector, the defense sector, and the disaster management areas are going to be areas where possibly in the next 2 to 3 years, we're going to see a lot of usage of these drones. So typically, in the capital markets, there are few companies which are definitely going to benefit here. Some of them are small, some of them are large. But the point which is very important is that this is a space which is now going to be on the radar of many investment managers. The drone policy will also help use drones in some B2B segments like QSR, maybe e-commerce, or maybe for some logistic companies for delivering products and over nearby locations. So I think the opportunity is huge. but the bigger trigger will be used in defense and agriculture, which the government wants to push aggressively. So I think, the ground has been very clearly, very well laid. The pitch has been developed now by the government. Now it's up to the private sector, and obviously the listed companies which have the technology, the skill, can definitely expect to get huge order wins over the next, say, 2 to 3 years. Now, typically, here again, to add from the IT space, I've been telling this on media quite regularly that within IT we like SaaS companies, software as a service companies, and there are few companies which are listed. Unfortunately, a large number of SaaS companies are still owned by the private equity companies, but there are 2 3 companies which are listed, operating in the banking, in the treasury, in the insurance space. There are some companies which are operating only in the hospitality and the hotel management space. These are companies where I think all of you should keep them on the radar, because this space itself is going to see explosive growth over the next, say, 5 to 10 years. Then we come to basically local, sectors like ethanol. Now, ethanol is one subject which has been talked quite extensively, but even today we find that stocks in this sector are fairly undervalued. In fact, not only the larger players but even the smaller players. I think ethanol is one input which is going to get significant upside over the next, say, 2 to 3 years, because the government is very keen that crude oil imports come down. A large part of the crude oil is substituted by blending, and already the blending ratio has been put at around 20% by FY25. So this is definitely a very big upscaling opportunity for the existing players. Our sense is that government will not backtrack on this, as earlier was the case, because the government has realized that now ethanol manufacturing is going to be given a very high kind of focus. So typically, companies which have got ready capacity are definitely going to make the most of it initially. We have found that even PSU players now, like GAIL, has also decided to set up ethanol plants. So clearly, demand is insufficient and supply is very limited. So I think in that perspective, even ethanol, selectively can be an area where investors can even look at these stocks at the current levels, provided their time frame is slightly longer term in mind. And then finally, we come to the core frontline sectors of the market, which are very important, and that is banking and financial. Now, a strong credit growth cycle is definitely going to benefit the banks, both the private sector as well as the PSU banks, housing finance companies, non-banking finance companies, and a lot of private sector, small size banks which cater to the MSME and the SME segment. Now, fortunately, interest rate cycle has also started moving up, so it may be bad news for the borrower, but good news for these banks, because typically when the interest rate cycle takes off, it remains, in action for at least the next 2 to 3 years. And normally, the asset quality during a rising interest rate cycle is the least. So that is something also which the market should like, and I think investors could definitely pick and choose, not only from the large cap PSU but the large cap private sector banks. But there are a lot of private sector banks in the mid cap category space where one needs to do a little bit of research before one targets any specific company. But broadly, we are positive on the large cap banks, because these are very solid banks with very strong balance sheets, a very large kind of loan book portfolio, and where the risk management is extremely solid, where the management bandwidth is also very strong. So these points make the larger banks, especially from the PSU and the private sector banks, quite attractive. And finally, just to end the session before we take up questions, I think we are also positive on domestic consumption themes. Typically QSR companies. We have seen that these companies have now started delivering top line growth of 25, 30, 35 odd percent. Then obviously, manufacturing sector, which includes the capital goods sector, the construction and the building product sector, is also one area where possibly a lot of growth could kick in. Telecom, which is a traditionally dominated sector by just 2 or 3 players, is continuously seeing increase in the ARPUs, and I think this is obviously because of the rise in the internet and value-added services. So I think this is also one space where one could see not only the frontline telecom sector but even ancillary companies, which cater to the telecom sector, should benefit significantly. And obviously, companies like Larsen and Toubro, Thermax, these are large capital goods players, so one can definitely keep these companies on the radar. And most importantly, construction companies, which were languishing even before the COVID, we've seen a lot of improvement in their order book. Companies, which are like Sadbhav, or maybe for that reason, a PSP project. Numbers for PSP project just came in today. So, on all parameters, these companies seem to be doing pretty well. So typically in a rising kind of, economic recovery kind of cycle, if the GDP grows, if the manufacturing sector grows, obviously these companies are going to benefit. And finally, please also look at companies which have got a lot of cash on their books, which have got very strong operating cash flow. This is the best time to look at quality companies, which are languishing because of poor market sentiment. And obviously that is going to make a lot of money for all of us, because data is very important. narrative is important, but more than the narrative, according to me, it is the data point which the company generates, which is going to make the stock re-rate going forward. And just to conclude, you know, what are the kind of sectors I would avoid, at least as of now? Maybe not for the next 5 years, but at least for the next 12 to 15 months. The first sector I would be avoiding is metals. I think metals is clearly on a kind of a downtrend. I think, despite the fact that we have seen very good numbers in the fourth quarter, the outlook on metal prices is little uncertain. I think we have been talking to many steel companies, and the one answer which we have got from metal companies, from the promoters, from the directors, is that steel prices are not going up. Inflation has started affecting demand, and that is something which is a little scary picture, because if at all the prices correct sharply, then the fall from year on can be even more bad. And I think one can expect, maybe the second, third quarter, of FY23 to show the full impact of this downfall. The second sector which we are not very comfortable in terms of valuations is aviation, despite the fact that it is an unlocking story. We believe that unless companies here record decent cash flows, crude prices don't come off, and obviously balance sheets don't improve, I think aviation is going to be largely a trading kind of bet and not a wealth creation sector. The third sector is paints. Paints has seen a lot of action of late, after the announcement of very large corporates decided to enter the market. I mean, Grasim has announced a very large entry in the paint market. JSW has already entered the market. And I think this has already got impacted on majors like Asian Paints, Berger, Kansai. So our sense is that, valuations in the paint sector are very richly valued. There is no margin of error here. And if you go wrong, you can go wrong completely badly. One aspect is the crude oil price, which is, of course, something which all paint companies face. But the more important thing is that if Grasim has entered the market, it's obviously a very dominant player in the cement, in the building product space. And therefore, in the next 1 or 2 years, one is bound to see some margin pressure coming in, despite the fact that, one can reasonably say that dominance of Asian Paint, Berger Paint would still continue. Then we come to FMCG sector. I think FMCG as a pack definitely is now a little more vulnerable, considering the kind of cost inflation kind of moves which we have seen in the market. Almost every FMCG companies has reported raw material cost inflation, and it is unlikely that this raw material cost inflation will go away in a short time. So I think as of now, I would be little little careful on putting my money on a Britannia or maybe on a Giver, or for that reason even on a Marico. I think these are all segments which could face a little bit of pricing power pressure, because obviously when raw material prices are increasing, it is unlikely that they could go in for very sharp pricing. And then finally, the oil marketing companies, which a lot of guys have been telling me that fourth quarter has been very good. Largely, that has been good because of inventory profits. These companies benefited because of the older crude which they had in their inventory. But if you look at the crude price post January, I think one thing is very clear, that my sense is that April to June may be a very challenging quarter, and I think that is the reason we've seen stocks like IOC, BPCL, HPCL, despite very strong numbers, the stocks have more or less flattened out. So I think outlook there will depend on how quickly crude prices correct, depending on how the Russia-Ukraine war culminates and gets over. And finally, my thinking is that the last sector which one should avoid is basically the new internet, companies like Paytm, or for that reason Zomato, Policy Bazaar. These are all companies where businesses are great. The business will definitely survive in the longer term, but valuations still don't leave that kind of comfort for the investors. In fact, if we look at all the losses of all these companies, my sense is that most of the investors have burnt their hands very badly, and I think it would be at least be a couple of years before really value could emerge in this space. So despite the fact that the opportunity is very large, the business model is good, the valuations for retail investors is probably not the right valuation as of yet. So friends, I think this is what briefly I want to touch upon. I think we can take now question answer session, and whatever company related or sector related queries all of you have got, I would love to answer them.
That was really, like, you covered all the sectors, major sectors, and it was really interesting on your part, Avinash. Thanks for that. I have one, two small questions, and then we will ask Shashank if he have any query from the perhaps chemical pharma question, and then we will ask the audiences to come up. Avinash, with the formalization of economy, we are I mean, in various sectors, the share of the unorganized players are moving on to organized players. So I want to know your view on this thing, and the PLI scheme which government is very vocal about. So going forward, how you see it will impact various sectors, and yeah, please.
Yeah, I think as far as the unorganized share, reducing and getting converged with the organized sector. I think that is a trend which started with the GST. Now GST have become a very dominant kind of revenue kind of force for the government. And I think as and how GST numbers increase, what is happening is in many sectors where unorganized sector was a very large component, that is going to obviously reduce significantly, and that is going to give a lot of market share expansion for existing players. There were a lot of companies in the plywood sector which were unorganized. Now things are getting better there. For that reason, even within the pharma sector, or maybe for the auto component sector, or for maybe even the consumer durable sector, there were a lot of unorganized, unbranded kind of products sold in the market. So I think in India, this is definitely going to be a very strong team, which is going to obviously benefit the organized sector in a significant way. As far as PLI schemes are concerned, I would believe that on ground, we have been talking to many corporates. The policy is good, but corporates are still a little uncertain and a little cautious in committing money, in a very large way. For example, we met managements from Amara Raja, we met managements from Excite. I think very clearly these companies are looking at big investments in the electric vehicle battery, or maybe the lithium battery segment. But as of now, I think things on ground look to be a pretty slow. But yes, if you took a look at it from the next 3 to 4 years kind of time span, a lot of FDI investment from foreign companies, a lot of investment from Indian companies is going to come in. And I think that is definitely bound to, obviously facilitate more and more technology, more and more new products in the market. And obviously, people have to see PLI has a long-term kind of investment. It is not something which you invest money today and the revenue or the profits comes from the second year. So in that perspective, I would believe that it's still a long way before one could reasonably say that it's going to be a very positive road for all the companies opting for PLI.
Yeah, Vinash, thanks. So, Shashank, you want to ask anything from Avinash?
Yeah, yeah. Thanks for the opportunity. So, yeah, you have given a very good overview about almost all the sectors, what's actually is going on currently into the environment. So, my again a question is like I would like to know your view and how actually you probably look for the specific stocks, say into a chemical or a pharmaceutical as a sector, because here it is not a sector approach. It is like mostly like a stock specific approach. So how you filter it out, and what are probably your criterias where you generally look for the companies which have a potential to grow in future. So that is my first question. And second question is like to benefit for all our audience, like how one should handle the volatility in a market, generally who is a focused small cap investor, because compared to Nifty, like the volatility into a smaller company is always higher. So how one should look the volatility parameter, and how one should probably hedge or like able to surpass this cycle. Thank you.
Yeah, I think Shashank, thanks for the question. I think the first question, I think you have a very strong expertise on pharma and chemical. So honestly, I'm not very good in pharma and chemical, but let me tell you the approach which I take. Basically, see, I look at the company's product, and as I told you in my initial kind of remarks, that there are many companies which make import substitute products, and these products are basically game changers. And this, product strategy actually works out very well for companies, because these are not sector kind of companies. These are companies where the entire fortunes of these companies is dependent on two or three key products, which are clearly going to make a lot of money for them. In this aspect, we looked at Deepak Nitrite when it was 300, 350 odd rupees. We luckily had some connections in the in the chemical market. We met some dealers, and then we met the company. We got a sense that the phenol and the acetone opportunity was a very large opportunity. Obviously, prices which were imported were slightly higher. What Deepak Nitrite did was that it obviously commercialized a very large unit, and obviously not only reduced the prices but logistically could offer the products at a shorter notice to domestic customers. Now, this was a very big key selling point for Deepak Nitrite. Now, similarly, if you look at products like titanium dioxide, now I just told all of you what is the outlook on the paint sector. Now, it doesn't mean that the paint sector is going to go into some sort of recession. In fact, the paint consumption is going to grow significantly. You got players like Asian Paints, Berger Paints, Kansai. Apart from that, now if you've got Grasim and if you've got JSW which is coming up, see the entire story is basically the volume of consumption is going to increase, but margin pressure will be seen by these companies. But the guy who makes the key raw material, that is titanium dioxide, is going to make a lot of money. And I think this is data which is already available to the public. Almost 80 to 85% of this product is imported. There is a huge amount of supply deficit in our country, and this product is definitely going to be a big game changer for a company like, let's say, Make Money Organics. So here also we had a very detailed discussion with the management. We realized that in chemicals, these guys have a very integrated structure. They know exactly how to look at companies, how to value sick companies. In fact, the titanium dioxide opportunity has come to them by via acquisition in the form of Kilburn Chemicals, which was a sick NCLT company and located in Dahej, where they have their existing facilities. So some sort of integration, some sort of logistic benefits, obviously we see whenever we look at such companies. And most importantly, obviously the demand supply mechanics, the implications whether this product can be imported, whether there is some sort of expectation that this product could be flooded by countries like China or some other country. These are the kind of other checkpoints which we normally do. But typically, when we look at chemical companies, especially when I look at chemical companies, we look at some specific products. For example, there is a product called PCCA, which, there is only one company in India and globally about 5 or 6 companies which makes, and that product is called as PCCA. The exact terminology, I'm not aware, but this product is basically used abroad by a lot of, customers physically in, chlorinated waters. Basically, since post the COVID pandemic, there was a lot of the virus kind of infection for people who used to go for swimming or used to go to beaches. So this chemical is actually used in water. Bodal Chemicals has acquired a company abroad, and it is the only company in India and possibly in the entire Asia which is going to manufacture this product. The potential is expected to be very strong. So, whenever you obviously come to know of this kind of product categorization, product specialization, obviously it becomes a key trigger point. And I think then obviously we obviously also look at the fact that how this product is scaled up in in terms of revenue, in terms of profits, in terms of cash flows. So obviously, by looking at the product initially and then doing a little bit of groundwork, and scuttlebutt by talking to people in the market, we take a call, because these kind of companies you may not be able to identify by purely looking at their balance sheets or by looking at their annual report. You need to understand their product strength, you need to understand their product strategy, and obviously on ground, how are these products doing, because finally the end customer is the biggest kind of the proof that this product will continue to do well. So this is the first answer to your question. And secondly, you mentioned about volatility in the small cap, mid cap kind of stocks. So I think, Shashank, I've been on the equity side and I've been known in the market for small cap and mid cap stocks. So clearly these are stocks where the risk reward is very high. And on the other hand, when the market corrects also, the drawback is that the drawdown in these companies is also equally larger. Now here, basically what we try to do when we look at any company which is in the small cap or the mid cap space, is that we believe that how strong is the business model, what is the leverage on the balance sheet, what is the sustainability of that company, moving forward and getting into the bigger league. Because obviously what is small cap, mid cap becomes a larger cap kind of category of company, provided everything falls in place. So this is a high risk strategy for investors who want to make a significantly higher kind of return as compared to the large cap stocks. Because today, all of us would agree that large caps would not deliver more than 15-16% in a year. But on the other hand, a small cap or a mid cap, if its valuations are good, if the growth story is good, if the business model is strong, if the capital allocation is right, then I think you could even expect 25-30% upside year, in a reasonably good time. So I think it depends on the risk appetite of the investor, but very clearly, volatility in these companies is definitely going to be on the higher side, because obviously here the liquidity aspect is also an issue. Many small cap, mid cap companies have got a limited liquidity, in terms of the number of shares floating in the market, and most importantly, several HNIs or several, maybe high net worth individuals are basically have usually corner these kind of companies. So timing, these companies at the right price to enter these companies is very important. If you enter the stocks at the right price and at the right entry point when the inflection point is going to happen, I think that gives the maximum, alpha in these companies. But definitely, if these companies, significantly go up and then somebody tries to buy them, then the incremental upside is obviously limited. But having said that, in conclusion, yes, the volatility will remain year high. Because unlike the large cap or the the medium cap companies, here the liquidity is a major issue, and the institutional investors normally don't chase these companies initially. They wait for the market cap to become from a 500 crore or 1,000 crore market cap to roughly 3,000 or 5,000 crores, and that is when large investors come. So I hope I've answered both these questions.
Yeah, thank you very much.
Thanks, Avinashi, for the great briefing. You actually covered actually the entire index, I think. So I'll leave questions to come from participant on sectors and company wise. I just have one question and one broad comment. We were talking about the PE ratio of the sector, which has come down from 25 plus to 19. Actually, what has happened in last 5 7 years, the index constituents have changed dramatically. Now we have more higher PE stock. Something like FMCG has more weightage, insurance has got weightage, which was not there 5 7 years back. So yeah, actually comparing historically, we are even deeper undervalued if you compare the historical PE ratio. Only question I wanted to ask on a broader level is, say 2 3 years back, we used to see there was very narrow market, only 10 15 stocks used to make money. You see index movement higher, but your portfolio is not performing in an equivalent manner. But post COVID, we saw that everyone was making money, every stock was making money. What's your view now that whether the participant making is also going to be a broad base, where there will be all kind of sectors and all kind of market cap companies will make money, or we can move to a narrow market where again we will move like only selected few are making most of the return while others are languishing. Just that view, and then we will open for sector question from participants.
Yeah, I think Ravi, nice question. My sense is that you're right that there was a large amount of domination before COVID. Some of the heavily owned sectors were doing well, and the other part of the market used to underperform. But I think going forward, now post COVID, what we have seen as of now is that a lot of retail money has started entering the markets. In fact, that is the reason we see a lot of domestic mutual funds buying in these kind of market despite significant selling pressure from the FIs. So I think retail investors are definitely looking at a lot of broader market companies, and I think the broader market still looks pretty attractive if one takes the next 2 to 3 year kind of view. Because what has happened is that many companies, have seen a lot of operational improvement in their working, a lot of operational improvement in the management bandwidth, and most importantly, I think as everyone agrees that in the large cap category, if you look at a Page Industries or if you look at a MRF or you look at a Bajaj Finance, I think these companies are all well positioned. Definitely they will grow. But in terms of the incremental upside, Ravi, I would not be surprised that this is not a place where retail can make money. And institutional, buyers whom we talk quite regularly, they have also understood, that ultimately the big money is going to be made in the mid caps and the medium sized companies because that is where the growth alpha will kick in. So I think you're going to see a broader participation. Yes, but one thing is very clear that companies which are not very strong operationally in terms of their business model, companies which don't have a very strong balance sheet, companies which don't have the kind of cash flows to support their business, these are the kind of companies which are going to be avoided. I think nowadays investors have become very intelligent, very well read. Nowadays a lot of data in the form of inputs on television channels or maybe on WhatsApp groups, a lot of people have got access to this, and today I think information flows much faster than what we think. So to that extent, I think the weaker set of companies are definitely not going to do well. So I think companies like Reliance Power or for that reason Jaiprakash Associates, all the penny stocks which did well even during the COVID years. I think those kind of days are completely over. I think and investors will have to realize that making money in 2022 is going to be a very big challenge because it's not going to be an easy market like the previous 2 years. So I think you need to have a lot of patience, you need to have a lot of maturity, and you need to take a slightly longer term view if you want to build a wealth portfolio for you. So I mean, that's what I would think, that money will be made in the medium size small cap companies, but yes, definitely in the larger cap, institutions will play a bigger role. And obviously mid cap and small caps would first be targeted by the HNIs, and then obviously once market cap expansion happens, then you will gradually see bigger hands coming and participating in these companies.
Understood. Understood. Just a follow up. You were talking about the fund coming from the mutual fund. What we have seen in last 7 8 months, FII withdrew some 1,80,000 crore, which has been pumped by DII. So, any sense we have how much cash as a percentage of MF of equity MFs are sitting on, or something insurance gives their data that how much percentage allocation they have increased towards equity versus what they used to held on debt. Anything on that, if you have any insight to share?
Yeah, I think I don't have the latest data, Ravi, but from what I understand is that most of the domestic mutual funds are sitting on say 15, 16% of cash even as of now. There have been some aggressive funds who have bought in. There are some funds who are sitting on 15, 16% of cash, which is yet to be deployed. So I think probably you will definitely see some sort of selecting buying coming in, as and when things get clearer. I would believe that from a very near-term perspective, which one point which I missed out telling all of you is that we have to be prepared for some more painful times, at least for the first quarter of FY23. Looking at the fourth quarter numbers, from many companies, the large companies, the smaller companies, one thing is very clear that top line growth has come in. The margin expansion has not happened. In fact, margin contraction has happened. And I think that, momentum will definitely continue in the first quarter of FY23 also. So June quarter may not be very great from a market standpoint of view, and we may see some kind of flatness or sluggishness in the profitability trend. So we need to keep this in mind very clear, Ravi, before we take a call on which company we want to bet on, because I think in the near term some more pain in the market could continue from the quarterly numbers which have started trickling in from fourth quarter. So this is something which may not look nice and encouraging for all of us, but as a reality we may have to face it, and that reflection will probably come in the first quarter of FY20.
Sure, Avinash.
So guys, okay.
Uh, I guess what we were discussing was something around 15-16% of cash at a mutual fund, and historically, I think they used to be lower than 10%. So there are enough ammunition from MF side to deploy in case we see incremental selling coming from FIIs. And I would like to sum up one comment which was made by Avinash, that money making would be difficult. What has happened in previous cycle, there was a lot of companies which hasn't performed well before this post COVID era. They ramped up 4-5x and everyone was making money. But you need to see a company like an animal, how they have performed in previous few beer cycle, and then only you can gauge how they can perform from here. So all those fancy returns which was generated only in last 2 years, you need to see those companies how they have performed for a longer time cycle, and then you can take your call. We can open floor for Q&A. I guess there are lots of people here.
So, guys, we are opening this floor for questions. We already have two speakers with us. We'll be taking one by one, and those who have any queries, they can send their request. We'll take one by one. And guys, those who are enjoying this very educational session, I would request them to check the handles of the panelists, and definitely it is going to add value to your investing journey. And do shower your love, and do share your feedback. So with this, Balendru, you can unmute yourself and ask your question.
Palendu, you need to unmute yourself.
Balindu, can you hear us? Yeah. So we have Mukesh with us. Mukesh ji, unmute yourself and ask your question.
Yeah, can you hear me?
Yes, yes.
Yeah, good evening. I'm from my investors among the Adani and among the say Ambani group, where one aggressive investor can bet on for the long-term purpose. So, if you can throw some light on that, that is number one. Number two, what is your view on PSU segment, particularly PSU banking and PSU segment? Thank you.
Yeah, I think I'll take the second question first, because I think it's little easy to answer that. So as far as the PSU space is concerned, Mukesh ji, I can tell you one thing, that the PSU banks have become extremely stronger in the last 1 to 2 years post COVID. And I think if a classic example is a bank like State Bank of India, I think classic example that after a very long period, asset quality issues are long now way behind them. The kind of credit growth cycle which is expected to come in the next couple of years, double-digit credit growth cycle is definitely going to ensure that their asset quality remains intact, their loan book grows at a very strong pace, and I think the markets will definitely reward them with a bigger price to book multiple. Currently, the price to book multiple is nowhere compared to the private sector banks like an Axis Bank or maybe an ICICI Bank. So typically, a lot of re-rating will come in. I would be a little skeptical on the smaller PSU banks because here the bigger issue is on the management. In most of the banks, the most important thing is the guy who actually drives, the leadership team in the bank. If the leadership team is driven by somebody who's not, very much favored by the market, by the analyst community, I think, and the numbers don't come out to be great, and I think you may not find a lot of value there. But given the fact that these banks are large enough, I think banks like maybe a Bank of Baroda or maybe a Canara Bank or an Indian bank, these could be good investment choices provided you have a viewpoint of at least 2 to 3 years. But I think one thing is very clear that these banks are dominated by government kind of initiative. So tomorrow, if there is some loan mela or there is some kind of political kind of announcement made for these banks, then it could obviously affect their balance sheets. But these are old days. I think going forward, even the government is aware that they would not like to obviously take some arbitrary decisions for these banks. As far as the other manufacturing businesses are concerned, there's a lot of value in railway infrastructure stocks. There's a lot of value in basically the building product segment, real estate segment where these government companies operate. I think very clearly, we have seen that even LIC, which got listed at a discount to the market price, to the IPO price. So I think markets obviously give a longer time for PSU managements to actually take off. Uh, Most people expect these companies to be slow movers, unlike the private sector players, which are more aggressive. So I think unless you have a very low risk appetite in the market, then only I think you should allocate a large amount of your money in PSU companies. Maybe out of a 100 rupee, maybe not more than 15-20 rupees, but the rest of the money should be allocated to the private sector kind of companies across banking, financials, or for that reason, manufacturing companies. Because my sense is that real money would be made by the private sector guys. I mean, the PSU companies have not made money for investors in the last 10 years. And I think nothing is going to change dramatically going forward. So, that is something which you must keep in mind that if you want to make a bigger risk reward, then I think you must have private sector more in your portfolio. PSUs will make money, but they won't make that kind of money which private sector has the potential to do so.
Okay.
And your first question on Adani, see, frankly, I'm not so knowledgeable to talk about Adani Group companies. My sense is that Adani Group companies, frankly, do not have the kind of cash flow generation capacity because a large part of their business is generated by debt. From what I've been reading on the internet, plus what I've been reading, from research reports, is that this group is sitting on a 2 trillion kind of debt, and the latest acquisition of Wholesale for both Ambuja as well as for ACC has also been financed by debt. So I think one must not forget the fact that debt is a two-way kind of sword. It works beautifully in a bull market when everything is going perfectly well, but when things go wrong, I think the debt on the books is something which will actually be a kind of a very big kind of negative for this group. So my sense is that one should not make comparisons between Adani and Reliance, that is Mukesh Ambani, because see, clearly if one sees both these groups, one thing is very clear: Reliance is a company which is net cash positive, and most importantly, it is following a proper strategy, a proper process. Unlike Mr. Adani, where we keep hearing acquisitions, every second month. And overall, I think this has been a stock which has been favored largely by the trader community. If you look at the fundamentals of all these companies, except Adani Ports, I think all the remaining companies seem to be extremely overvalued. And I would personally not buy these companies. So, unless you are a very high risk appetite investor who probably would like to, take a very high risk, this is not meant for, steady as well as, long term investors, because clearly debt is something which makes me uncomfortable. So, that is my answer to this question.
Avinash, one follow up on this. Say for Ambani companies, do you see sense a possibility that since startup funding are drying up, say many of the startup companies next year will be available on the block, and Ambani can pick them, choose them for a dime for a dollar, those kind of acquisition he will do bolt on. So opportunity, because what we have seen, he has done tremendous kind of acquisition on the new tech companies recently, and now since funding goes dry for startup, he will have plethora of opportunity to acquire something business which has been there for 3 4 years and now available dirt cheap. Any sense, any possibility of that might come in next 2 years?
Yeah, I think Ravi, very good question. And I think you're right in saying that, Mukesh Ambani has always been a very aggressive buyer of good companies at distressed valuation. And I think, looking at the kind of situation in some of the startup companies, where cash has completely gone dry, they don't have money, the cash flow in the business to operate their businesses, I think would definitely become potential targets. Now, which companies and which segments, Mr. Ambani would target is difficult to point, but my guess is that there is definitely a concerted strategy where new age companies, internet driven companies are on their radar. And since they have a very large M&A team, I think Ravi, this is definitely a matter of fact that maybe the next 1 or 2 years you could see a lot of acquisitions coming out. And obviously that is definitely with a very well concerted strategy that data is going to be the new oil in future, and obviously all internet related businesses are going to make a lot of money provided their cash burn and their cash flows are initially taken care of by a large parent. So this point is definitely very likely that this may happen, but with what propensity it happens and which companies are taken over, we'll have to wait and watch.
Sure, sir. Sure. Uh, yeah, we can take questions from Puneet.
Hello, can you hear me?
Yeah, Puneet, go ahead.
Yeah, Avinash ji, एक question ये था, like in this downfall, whatever we have seen in this turmoil from like past 8 months, there have been a lot of mid-cap IT companies. Those might look attractive. Those might generate like 20 to 25% of revenues. But what is the business? What are the things we should look in companies? For example, let's say we should look for companies who are more into like Tableau, digital integration or cloud infrastructure management. What are you seeing is the more revenue generation or a kind of trigger that an investor should look into these companies, because they're actually coming at a very good discount rate at these times. So what should be the key thing that investor should look into this?
Yeah, I think I think first of all, one should understand what are the key challenges for most of the large as well as the mid-size IT companies, and that is basically the cost of employees. I think attrition levels have reached record levels, and I was just talking to a friend in TCS just a couple of weeks back. He told me that the attrition level will get further accelerated in the first quarter of FY23 also. So larger companies are seeing a lot of key employees exiting, joining startup companies, getting very fancy salaries, although this may not continue for long. But then in the very short term, what is going to happen is that larger companies can still afford to buy an expensive or a costlier guy and replace the old employee. In case of mid cap and the smaller companies, it's little difficult because obviously their margins and their profitability in absolute terms are not as large as companies like say a TCS or a Infosys or a HCL Tech. So your point of saying that whether IT companies are good investments, they're available at attractive valuations, my sense is that maybe for another quarter or so, at least till the June quarter does not get over, in mid-cap IT companies, I think this would not be a right time to put incremental money. I think it's better to wait and watch for some time, because attrition is one aspect which has now been faced by most of the IT companies in a very significant manner. In fact, post COVID, what has happened is digital, cloud, or for that reason, artificial intelligence, machine learning. These are all areas where there's a lot of demand for such kind of professionals, and obviously companies operating in these areas are obviously making a lot of money. But on the other hand, they have to obviously pay fancy salaries to their employees so that these employees stick with them and deliver on the projects. As far as the traditional IT companies are concerned, like a TCS or a Infosys or a HCL Tech, there I would expect that the cash flows are more steady in nature, and obviously there the vulnerability to the attrition is taken care of by the volume of business they generate. So I would believe that whenever you look at any mid cap IT companies, please look at what are the business verticals the company is into. Secondly, what has been the attrition rate in the last say 3 to 4 quarters, And most importantly, what is the demand outlook, suggested by the company? I mean, most of the company conference calls or the investor presentations give you a fair amount of assessment on that. And after that, one has to take a calculated call whether one has to invest in these companies again from a medium to long term angle, because as the markets are volatile, if the attrition level increases significantly for the next say 3 to 6 months, you're going to see margins coming under pressure. Companies like Infosys saw an attrition level of almost 27%. So mid cap companies could even face higher levels. So that is probably the biggest challenge for these mid cap IT companies. So I think no need to hurry. I mean, these are definitely good businesses, but as of now, I would be a little skeptical in putting my money immediately. I would prefer to wait for the June quarter, let the June commentary come out, and the attrition level be known to everybody. Because only when you're sure, then you can invest in such companies. Because here the alpha generation is good, but the risk capacity also has to be there. These companies can correct also by 25-30%, and that remains a major risk for most of these investors who prefer to buy such companies.
So just one question in addition to that. Hello.
Yeah,
Hello.
Puneet, go ahead.
Yeah. So just one question in addition to that. So in that sense, let's say you're saying we should wait for another quarter to see what the proceedings are, what the commentaries of the different managements are. It's better to look at the traditional companies like the bigger ones like TCS, Infosys, or there is like a scope of seeing these companies, mid cap IT companies, because the big daddies won't make much alpha for the retail investor.
Yeah, I think you must understand one thing, that if you have the capacity to take a bigger drawdown in your portfolio, then you can even think of buying these stocks even as of current level, because they have corrected significantly. But if at all some further negative news flow comes in, then mentally you have to be ready for a drawback, like another 15-20% if these companies go down. Then you need to have the maturity and the conviction to hang on here. That is very important. Like today, TCS is down to 31, 3200. I won't be surprised that maybe around 3000 or 2900 it could at best correct. But one is not sure as to what could be the extent of correction. But especially in large cap companies, the course correction could be significantly lower compared to a mid cap IT company. So it all depends on your risk appetite. See, basically, we are saying the long term story is intact. These companies are earning dollars. These companies have got reasonable cash on the books. But if you're expecting the alpha to come in the next 3 months or 6 months, that is something which is really something which is very difficult to believe. So here you got to take a 12 to 15-month time frame. And obviously, rather than buying in lump sum, buy small quantities whenever the market corrects. So that ensures that your capital is correctly allocated, and you probably get the best price when you look at your average cost for such companies.
Agree to you.
Agree to you.
Thank you.
Thank you. Yeah, thanks, Avinash.
Puneet,
So,
just to
Good
add,
evening, sir. Sir, can we have your view on InfoEdge?
I think Info Edge, if you ask me honestly, when the Zomato IPO came, it was considered to be one of the prized kind of companies, because Zomato was one of the companies where Info Edge had invested a lot of money. But my guess is that clearly looking at the kind of structure of Zomato as of now, the stock has gone up because the management gave some positive commentary that they would soon be profitable. But unfortunately, they seem to be burning a lot of cash. And I think if you look at this business may look very attractive, but unless it generates real operating EBITDA, operating cash flow, and obviously it really generates value for the shareholders, we are not going to see a very big upside. So now InfoEdge is largely a holding company. It has been nurturing a lot of these startups, a lot of these digital companies, including Zomato. So my sense is, unless you've got a 2 to 3 year kind of time frame, InfoEdge is not a company which is cheap on any grounds, based on price to earning multiples or EV to EBITDA. On both these parameters, it seems to be richly valued. So my guess is that despite the fact that it's a uniquely positioned business, it's a uniquely positioned set of companies, which includes real estate, basically Naukri.com, which are all very unique and strong properties. Real money will be made only if you hold on for the next, say, 3 to 4 years. So, it's your call. I mean, whether you want to stay invested for the next 3 to 4 years, but valuations are definitely not cheap by any standards.
yeah, great. I hope this answered his question. So, Avinash, I would like to take a moment to ask you. You should tell the audiences about your fundamental mentorship program, so that they are well aware and they can reach out through your handle or maybe.
Yeah, sure. I think thanks for that. See, now, just to inform all of you, we run a fundamental mentorship program. We have a basic level, and an advanced level. The basic level is actually meant for guys who are new to the capital markets. We basically ensure that we have several question answer sessions in the in the program where once the session concludes, we explain a particular concept. We have a proper 35-40 minutes Q&A session with all the participants so that it helps the session to become very interactive. And what we try to do in this basic program is that we actually take the entire journey from a company to how valuations are looked upon. Then what are the things you should see in the balance sheet? What are the things you should see in the cash flow? What are the mistakes you should not commit? How companies commit fraud? So basically, the basic program is a very basic oriented program for investors who want to make their first journey in capital markets and people who want to build a wealth portfolio on their own. So the people who don't want to go to an advisor but want to invest on their own should definitely first try to educate themselves. As far as the advanced program is concerned, we try to bring a lot of practical examples and cover various sectors, like about 10 to 12 sectors. And we discuss very important metrics like what is operating leverage, what is the benefit of sector turnarounds, how sectors are selected, what are the turnaround signs in any particular company, and basically how wealth is made by investing in the right sector at the right time. So this is also a 3 month kind of program. I would suggest if anybody is interested, they can tweet me. I can send them the entire content schedule what we teach in the basic and the advanced program, by which all of you can understand how detailed this program is. And all these videos are shared by us. We have a website by the name of Avinash Mentor, where all these recordings are available to all the paid participants. So anytime you want to have a look or revise any concept, you all are free to do it. So basically, it's an interactive live program as well as a recorded kind of version is provided to the participants.
Thanks, Avinash, for that update. We can take a question from Abdul. I guess he has his hand up for a very long time. Abdul, go ahead, unmute yourself.
Thank you for entertaining the question. Can you hear me?
Yeah, go ahead.
Yeah, so I just wanted to your take on the global macro environment at the moment. So oil and the USD has always have a negative correlation, but this time we see a very unusual thing that we have higher USD due to interest rate increases by the Fed and a higher oil price. So what is your view on global growth and how it would be affected due to the rise in interest rates by the central banks that we've been seeing all around the world? And we're also seeing a rotation and change in allocation from growth companies to value companies and basically fixed income instruments. We've been seeing that for the past 2 months. So, what is your take on global growth and the change in asset allocation in the Western developed equities?
Yeah, thank you for that question. See, first of all, I would believe that global equities are going to see some sort of a demand contraction. And I think recently the US GDP data had come in, which clearly hinted that there was some resistance in terms of the US GDP growth rate was concerned. And as you rightly mentioned, that US is now experiencing high interest rates. In fact, the Fed has clearly mentioned that their first priority is to bring down inflation, which has touched record high levels. And that is one aspect which has hurt the currency. In fact, the dollar has appreciated, the Indian rupee has depreciated. So my sense is that as long as the crude oil prices remain firm, interest rates remain up, it's going to be a very big challenge for the US economy, because this is going to hurt the profitability of companies here. More importantly, the new age companies, what has been very disturbing is that companies like Netflix, companies like Amazon, companies like Google, I think we've seen a very deep correction in these companies which were considered to be basically very strong on the earnings growth side, and which were completely non-affected by macroeconomic factors. But even here we have seen that numbers have been pretty weak. I think the guidance given by these companies is also very cautious. So I think going forward, the next 3 months, at least the next 3 to 6 months, is going to be very volatile, very challenging. And the kind of movement we have seen in the Dow, in the Nasdaq, clearly points out that we could see a lot of volatility in the days to come. Now, as far as how this is going to impact the equation for most of the emerging markets, is that these FIs who have invested basically from US and from Europe, a lot of money shift is going to happen. From emerging markets, money is going to flow back on the US debt side, where interest rates have gone up, yields have gone up, and where I think now the new appetite for investors here is to play on the debt market, which is consistently giving better returns in terms of the M2Ms, as well as basically a more safer kind of haven as compared to the equity return. So compared to last 2 years, I think US equities could definitely be in for a rough kind of patch. How the economy takes off, how the interest rates actually manage to bring down inflation is something like a challenge. And even as of now, it's very difficult to visualize whether inflation will come down only by increasing interest rates. So I would believe that it's going to be a matter of at least 2 to 3 months before we see some conclusive data points. Till that time, I think as long as the US market fluctuates, that is going to have an impact on all the emerging markets like India as well as China, and probably that is definitely not a good sign. So in that perspective, the rest of 2022 is going to be pretty challenging. So these are my comments for your question.
Avinash, if you allow, I would like to add something here. Few things, like you were asking about bond yields and equities. There was some report from GS few months back. They were saying in last 40 years, there were only 3 years when debt and equity both underperformed simultaneously, that there were negative return for bond holders and equity holders in the same year. So only 3 years in last 40 years it has happened. Now this is year till date CY 2022. Again, we are seeing drawdown on bond and equity both. Whenever this has happened earlier, the next subsequent 2 3 years, equity shareholder has outperformed the market from their historical benchmark. The second thing, you were talking about the relation between bond and USD. One thing we need to understand right now, what is happening in the market, whenever there would be any kind of crisis which comes in the market, global crisis, only thing we have to go back to fall on is US dollar. So that is one house. If that is kept safe, then the capital market sanctity will be safe. So whenever you see any kind of crisis, you will see appreciation in US dollar. Even if you remember 2008, the problem started from USD, but US, but it was US dollar which has appreciated against the emerging market countries. So again, the similar trend will happen. If you see the problem on the global economics, as countries are looking inward, you will see fund flow which can move from other emerging market, or even for that matter developed market, to US dollar side. Regarding correlation with oil, I guess both are a bit different this time, because oil is driven more because of war and dollar is more because of tightening in the US. One thing I would like to add here is something like, we were for 0 to 0.5% US interest rate for at least 2 3 years, right? And if the journey of normalization is towards 4%, from 0 or 0.5% to 4%, we have already traversed some 75% of that journey. We are already at 2.7, 2.8 10-year yield curve. So maximum time you pain you bear when you are traversing that initial phase of the journey. Now it doesn't matter if it matters a lot to bond holders that we might move from 2.8% to 3.5, 4%, but we have already covered 70, 80% of that journey. So incremental pain which can come if there is no incremental shock on inflation should be limited. And if you are not, one thing is there, you were talking about value and growth stock. What used to happen when you are in an ultra low interest rate, whatever small cash flow you generate, you discount it at a very low discounting rate, and hence the present value of your terminal value, present value comes appear very large. So that was the reason when no cash flow, low cash flow generating companies were valued very premium. Now you are entering into a phase where interest rate is very high, borrowing and refinancing is becoming difficult. So putting any industrial kind of plant, say a power plant, a industrial unit, is becoming more and more expensive. And if those plant doesn't come according to the growth of the GDP of this country, what happens is the incumbent player becomes a more higher bargaining power. That's why we see the value is migrating from those value stocks to the from growth stock to value stock. Yep.
Yeah, thanks, Ravi. And Ronak has been waiting this long. So, Ronak, you can unmute yourself and ask question from Avinash ji.
Avinashi, thank you so much for replying to all the questions at in such a elaborate manner. So, in your opening remark, you mentioned that there seems to be a bit of value in banking sector, not only in PSU but even in the private mid-cap banking sector. So, in that, there are a lot of banks which are quoting at, in fact, half the book value, and so one would kind of think on that? Like, how do we evaluate the asset quality of such books, even though they are trading at half the book value? But it, at least for the past couple of quarters, the trend has been such that there is, in fact, more recoveries than the provisioning. So, how do we evaluate the asset qualities for the mid and small cap banks?
Yeah, I think very good question, Ronak. But let me tell you that there is no easy formula for doing this. I think you need to talk to the company managements every quarter. You need to attend the company conference calls. And I think the problem with the bank balance sheets is that only the bank knows what is the bad assets on their books. Unlike manufacturing companies, where you can go and meet the dealer, you can go and meet the customer, you can get a lot of information on ground. But unlike banks, you have to wait for the bank to report its asset quality after every quarter. So most importantly, I think you have to take a reasonable amount of a risk reward bet when you look at the smaller banks. I think classic examples have been banks like DCB, or for that reason Catholic Syrian Bank. These banks are trading at very attractive price to book multiples, but clearly their balance sheets are small, their book size is low, and obviously if they come across any bad asset, it could obviously hurt their bank books significantly. Unlike if you compare it to a Axis Bank or maybe an ICICI Bank, these are large balance sheets, where even a small one or two, kind of bad account, even if it does happen, it is not going to upset the momentum in the business. Clearly, I would believe that, leaving apart, banks like Yes Bank, which are completely, saddled with a lot of asset quality issues, almost 13-14% is the asset quality there. I would believe that, I think as a benchmark, I think, as long as the asset quality is between anywhere between 3 to 4% at the gross level, I think such kind of banks you can take a reasonable bet. And frankly, in a interest rate cycle upturn and an economy kind of upturn, obviously what you will find is not only the bigger banks, but even the medium size and the smaller banks will also start making money. But obviously you got to understand what is the business mix of that bank. Does it have a significant amount of fee income? Does it have a large part of only the core net interest income coming from the the core banking business? So I think all said and done, more than the price to book, I think particular parameters like the cost to income ratio, if it is reasonable, or maybe if you find that the ROE or the ROE is very decent, like any bank which has got an ROE in excess of 14-15%, ROA of at least 1.52% consistently for the last say 2 to 3 years. I think these could be good defensive kind of bets in the smaller bank category. And I think most importantly, focus on certain product categories like Catholic Syrian Bank. I was told that they have now entered the gold financing market in a big way, and they are one of the largest gold financing banking companies in basically in South. So I think apart from the bigger players like Muthoot and Manappuram, they have managed to now garner a large share in the gold financing business, which obviously gives them a better ROE, which gives them a better yield. So whenever you look at any bank, please look at what is the composition of revenue and whether that revenue is sustainable going forward. And most importantly, you need to have a regular interaction with the banks, because see, unless you interact with the banks both on a primary level and on a secondary level via the conference calls, analyst meets, by looking at their presentations, by reading their conference call transcripts, it's not easy for anybody to actually pick and choose the smaller or the larger bank. So I think a lot of inputs actually come from the management, which I think you need to do diligently if you want to invest in such kind of stuff.
Sir, I have a follow-up question on this. Do you segregate among banks something like private banks which have a growth engine of insurance, AMC, which are the sectors which will look on for next 20 years, compared to some of the plain vanilla banks where we only do banking, which is more or less of a commodity? So, any distinction which you can make of these two categories, even among the private banks, and how should we value these companies when they are coming with embedded growth option for next 20 years?
Yeah, I think another good question from your side, but I think this definitely is very important in today's business environment, because see, when you buy a bank today, I think the traditional core banking business is something which is not going to drive, valuations to a significant extent. What the market is also looking at is that does the bank have a decent exposure in insurance, in the mutual fund business, in the broking business? So I think obviously a package of all these elements, if it is there in any particular bank, either whether it is a private sector bank or a PSU bank, definitely adds a little more stability and growth potential to such kind of banks. So I think, classic examples could be ICICI Bank, or for that reason, something like an SBI, which has very cleverly positioned their presence across various multiple kind of, sector engines. And I think insurance is one sector where, my sense is that it's a very closed club kind of, position for most of the players there. It takes a lot of time for any new player to, break even and then start making money. So clearly, banks which have got a large exposure on the insurance side, on the capital market side, on the investment banking side, on the broking side, are obviously better positioned as compared to the plain vanilla banks. And I think, whenever you look at any bank, I think you need to keep this factor in mind, that apart from the normal core banking business, do they have investments in, subsidiaries which could add a lot of value? I mean, clearly, if you look at SBI, they have SBI Life, they've got SBI cards now. SBI is planning to take their AMC public very soon. So that also obviously will unlock a lot of value for them. And most importantly, what is the level of penetration with the retail, mass audience? Like, most of these larger banks enjoy a very large CASA. So obviously, whenever you look at any bank, I think the presence of a very large, strong CASA is something which is very important for any one of us, because that gives us a feeling that funding for these banks is going to come at very competitive rates, where obviously they can make a better yield in a rising interest rate scenario. So I think, Ravi, these things have to be looked upon as a prima facie must if you want to build a portfolio of banking stocks.
Yeah, thanks, Avinash. So, Avinash, do you have any view on City Union Bank?
Yeah, I think, see, numbers have come out pretty well. In fact, if you look at the loan book growth, the asset quality, the profitability, I think definitely it looks interesting. And I think, this is one bank where possibly, everything seems to be growing pretty steadily. Hopefully, in the interest rate cycle, if they manage their risk better, and if, the balance sheet increases, but at the same time, their loan recovery mechanism is more or less geared up properly, then I think you could definitely see a lot of good amount of value buying coming in here. But yes, again, from a longer term perspective, maybe in the near term, unless and until this bank actually shows a very large balance sheet, none of the larger funds or larger FIs would be keen to enter this. So it's going to be largely be an HNI or a retail kind of story here. But since definitely, if somebody were to look at it from a 2 to 3 year kind of time frame, then definitely City Union Bank has been showing very decent numbers. And I think at some point of time, valuations would catch up. But initially, I think, my preference will be on the larger banks, and maybe another, say, 10 or 15%. If one has to allocate, one could look at such kind of banks.
Yeah, thanks. So, Shashank, any other question from yourself? And in the meantime, Avinash, a very important thing like the behavior management in market. So, I would request you to tell the audiences how they can graduate on this front. I mean, managing their behavior in various market situations.
Yeah, I think that is very important. Basically, see, I think emotional management is very important. As the last time, I think I remember when Shashank had his, Twitter space, he mentioned that there were many books available by Parag Parekh, and a lot of other good quality content available on behavior management. So my guess is, I think, behavior management is something which all of us have to learn on their own. Most importantly, any investor or trader, when he brings in emotions in his decisions, at that point of time, money making becomes extremely difficult. A classic example is, if you have gone wrong in a particular stock for whatever reason, I think it is always better to cut your loss and exit the position, even if it is an investment call or a trading call. Unfortunately, what the retail investor, does is exactly the opposite. He hangs on to that stock for a number of years, for a number of, times, and then he believes that, that stock would bounce back sooner or later. So I think one has to be very clear as to what is the objective of that investment, what is the risk in that investment, and if it doesn't work out, then I think you need to exit that investment, free that capital, and move on to something else. So we need to be flexible, we need to be little mature, and we need to be very non-emotional when we take a call as far as equity investments are concerned. The only thing which I would request all the participants is that, people who do trading, intraday trading, and people who do fundamental investing, these are two completely different facets. So, if tomorrow a intraday trader wants to apply the same principle in fundamental investing, it will not work. There are many, traders who believe that investing based on fundamentals is also very simple, and you could possibly generate very good alpha in a very short period of time. Maybe it was possible in the last 2 years when stock prices, galloped significantly in a very short period of time. But we should not forget what happened in 2017 when there was a very big meltdown in the mid cap category of stocks. So basically, emotional mindset of the investor has got to be very strong. Uh, Always look at a panic situation or a crisis as an opportunity. In fact, a lot of people tell me that why normally I get interested to sectors when they are in trouble times is because you get good quality at a very good attractive price. You will never get good quality at the right price at a discounted level in a bull market, and that is the biggest problem retail investors face, that then they are forced to buy at any price. The investment saying buying at any price has actually resulted in investors buying companies like Paytm, Zomato, or for that reason Policy Bazaar, because clearly only the narrative was good, but the data points and the numbers which were coming from the companies were not evoking a lot of conviction and confidence from these companies. So typically, uh, if at all you want to look at investing in the market, then emotional intelligence is very important. Try to convert a crisis into an opportunity, but provided you have got a proper game plan and you probably invest in a company which has got some growth potential and which has got a very long term kind of runway for growth. So I think when you look at emotional intelligence, you got to apply all these metrics in a equal proportion, and then take a calculated risk, because in the market nothing is guaranteed, and nothing is as simple as a formula. So you have to go through the process, you have to fall down, you have to get up, and then you got to continue a journey. That is how you can actually take the help of emotional intelligence and at the same time make a decent amount of money.
Yeah, really summed up well. So you discussed a very important aspect, and even in the beginning, you have said like knowing the don'ts of market is more important than knowing the do's. So basically, coming to risk management. So how you define risk and how you advise the beginners to go about risk assessment and risk management.
Yeah, I think my sense is that I follow a very simple approach as far as manufacturing companies are concerned. Yeah, I always look at companies, which are run largely by the company's profitability or their own cash accrual. So any company which is, increasing debt every year, I think these are the companies which I would be a little skeptical and cautious. So I think the first, don'ts which I think investors should follow is that please be careful of companies which are increasing their debt levels every year, and most importantly, companies which are not generating the kind of operating cash flow in the business. See, because operating cash flow is the first trigger point for any manufacturing company. If you see a company which has got no operating cash flow, then the profit and loss or the earnings which the company generates is of no value. So basically, companies which focus on profitability, companies which focus on operating cash flows are the companies which are definitely interesting and which need to be put on your radar. The opposite side is companies which just generate profits but don't generate cash in the business are companies which have to be strictly avoided. So the second point is, please look at the operating cash flow generated in the business, because that is the first critical point to evaluate the management and the business quality of a company. And the third important thing is that we normally avoid companies, where promoters pledge their shares in a very large quantity, except for some official reasons. But otherwise, pledging is one word which is not liked in the markets. People always like that the promoter stock is, unpledged always. And normally we have seen that whenever the promoter pledging is very high, such kind of stocks evoke a lot of less confidence from the investors, both from the retail as well as from the institutional community. That is very important. And finally, just to add, we also, I mean, I would be little skeptical about other managements which actually are in a tearing hurry to grow. A classic example has been the Adani Group, where we hear acquisitions, expansions happening at a very rock kind of gathering space. And while this looks very good on paper, the implementation and the execution part of it is definitely not going to be easy. So I think today, whether we like it or not, all Adani stocks in the last 2 years have given stupendous returns. They've become, favorites of most of the trader community. But my sense is that from a fundamental perspective, uh, a debt kind of funding strategy in the end is not something which markets will like. We have seen examples like Anil Ambani, who was once considered to be the blue-eyed boy in the markets, but once the debt bubble actually exploded, these companies were not touched upon by anybody. So I think history repeats itself, and definitely I'm not presuming that this will happen to Adani, but my sense is that debt is a very bad word, and unless it is under control or maybe the business is generated entirely out of cash accruals, I think these are the things which are the first things which investors should look upon. Whether the stock is going up or down is not relevant. I think what is important is that your capital must be safe in those companies. So I think these are the broader points, which I think one should at least do a small cross check before investing in any of the companies they want to put.
Yeah, so true. And even in the case of Adani's, like going forward, we have general elections in 2024, and any uncertain event which the public don't like can be I mean, trigger for anything which can happen. So very rightly said. So Avinash, I mean, any two three picks for which you want to share your outlook? If obviously not the buy sell recommendation, but if you would like to in today's current situation, value buy or maybe.
Yeah, I think we are very positive on the ethanol sector. We are very positive on the auto component sector. So I think one or two companies which we bet and which we feel has got a lot of value even now. One of the auto component companies is a company which is into a very different product category. It's called product aesthetic, which is basically designing of the logo, designing of the door handles, chromium plated parts on the refrigerators. That is the consumer durable kind of items, and that company which we visited was SJS Enterprises. Now, this is a company which has got a very small top line of around 260 to 70 crores, but the EBITDA margins are in excess of 30%. And the company has a cash kitty of almost 150 odd crores on the balance sheet, completely debt free business. Our sense is that this product aesthetic business is going to grow by leaps and bounds, because nowadays, if it is two wheelers or whether it is four wheelers, I think what the car manufacturers want to do is they want to provide a differentiated product. Finally, a two wheeler, there is hardly any scope for differentiation. So basically, such kind of product aesthetics are being increasingly being used by the companies to actually attract the fancy of the customers. As far as the passenger car segment is concerned, this is a very large business abroad in Europe and US. In fact, this company exports almost 14% of their products to Viston, which is a very well-known European company in auto components. So my sense is that if somebody were to take a 12 to 15-month horizon, the stock has corrected significantly from 430, 440 levels. It's available below 400 now. So I think this could present a very good opportunity for guys who want to compound, at least 25, 30% over the next, say, 2 years. Earnings growth as well as, multiple expansion, and looking at the kind of profitable margins, very difficult to find companies where EBITDA margins are in excess of almost 30%. So this could be an interesting opportunity. And I think today the turnover is about 260, 270 crores. In the next 2 years, I would not be surprised if this reaches 500 crores. So top line growth could be facilitated by good margin kind of sustainability of 30%, which I think at some point of time the market would definitely give it a second look, because very little competition and very strong customer base, and the promoters have also got a very strong exposure here. And the second stock, which recently today, I mean, a couple of days, which I recommended in on the one of the media channel, which is the distillery and edible oil company, is BCL Industries. Now, this is a company where they have 50-55% coming from edible oil, another 30% coming from ethanol. And recently in January, they commissioned a 200 kiloliter per day, ethanol distillery in West Bengal, which is now running almost at 70-80% utilization. So our sense is that in the current year, both these trigger points are going to help the company. Today the company posted its numbers. The revenue was about 1900 crores, and the company posted a profit after tax of 85 crores, leading to an earnings of almost 35 rupees. So I think, in terms of the valuation comfort, if one were to look at next year as well as FY24 earnings, we would not be surprised that this could be a 2500 crore top line company comfortably in the next, say, 12 to 18 months. And quite frankly, the earnings growth is going to be significantly good. I mean, this year earnings growth was in excess of 20-25%. In the next 2 years, earnings growth is going to take off, and ethanol as a story is not going to go out of fashion. Ethanol is definitely going to sell very well for the company, and edible oil, prices have also, positively, improved. So that also is going to actually improve the cash flows for the company. So in that perspective, you're getting a stock at a multiple of less than 10 times, where the earnings growth visibility is at least 20% plus for the next 2 years. So here also, I think, the stock has corrected from 650 odd levels to levels below 400 rupees. I think here also, I think one can decently, obviously expect this kind of upside in the very near term. So these are basically stocks which could give you a very good alpha over the next, say, 12 to 18 months, provided the market sentiment settles down and I think normalcy kicks in. But definitely, in terms of valuation comfort, the risk reward is in the favor of the investors.
Yeah, thanks for sharing your outlook about those. So, guys, I once again request the audiences kindly check the handles of the panelist. And Avinash sir has over 3 decades of experience, and he's been into mentoring since long. And as you can see from last 1.5 hour, we are listening to his insights gained over 3 decades. So, guys, kindly check the handles to follow us so that we can come up with more such educational spaces, and you people can enjoy. And every word said has relevance, so everyone is requested to do their due diligence. So, Ravi, Shashank, any questions from Vinashji and or audiences? If you are left with any questions, you may also send up your request.
No, I guess we have covered lots of stuff, and I would sincerely thanks Avinash ji for having such enriching and insightful session for us.
So, Avinash sir, like seeing the current market situation, we saw like the sugar companies and other. I mean, of course, all the sectors have got the beating, but specifically the metals and the sugar sectors has bear the. I mean, they have been beaten badly. So, is it short-term pain or how you see going forward? I mean.
No, I think as far as sugar is concerned, I think it definitely is short-term pain because, as I told you, now the focus of most sugar companies is on making ethanol, which is going to be more profitable than selling sugar. And see, the sugar business is also obviously not very badly impacted. In fact, the export quota has not been completely disqualified. What has happened is there has been a limit of 10 million tons, which has been announced by the government. So I think this is going to happen from the new sugar season. So obviously, that is definitely going to impact the profitability of some of the sugar companies because sugar exports fetch a better realization. But if you were to look at their ethanol kind of contribution, I think most of the sugar companies, the larger ones like Balrampur Chini or Dalmia, sugar. I mean, all these companies have got large ethanol capacities, and I think you need to be very clear on the fact that ethanol is one clear secular story which is going to continue for a long time. As far as metals are concerned, I would not be comfortable, as I mentioned earlier, also that the indications which are being given by the companies is that metal prices are not going up; they are stagnating, and obviously inflation has obviously impacted demand for steel also. So I think it's not that metal sector demand is not vulnerable. Most importantly, despite the fact that infrastructure is going to kick off in India in a very big way, a lot of investments have been announced by the government. I think what is important for metals is that if global prices don't improve and global prices correct, then I think you're going to see a repercussion of that on the domestic players. And I think most of the steel companies have generated humongous returns in the last 2 years. So now incremental upside is going to be very difficult. So, in that perspective, I would believe that one needs to be cautious. If somebody has made 3x, 4x money in metal companies, please book some money on the table and keep some cash ready because once the fall comes, the fall will come at a very significant pace, and at that point of time it would be very difficult for investors to actually exit those kind of positions.
Yeah. So when we talk about ethanol, one name comes to my mind. So Raj Industries. So what would be your outlook on Raj Industries, sir?
Yeah, I think the company had its conference call. Now one thing which was very visible is that they are sitting on a record order book, and Praj is one company which is not depending only on the Indian ethanol market. In fact, they have been working on several R&D projects. One of them is CBM, that is compressed biogas. The second project is special aviation fuel, which is called SAP. Now these are all future generation kind of projects which have been lined up. And I think my guess is that if one were to invest in Praj today, I think one needs to take a 2 to 3 year view because the entire growth story will not pan out in the next 12 months or 15 months. You are going to see a significant amount of re-rating in this company over the next, say, 2 to 3 years. As far as the current year's business is concerned, I think the company is well on track on achieving its targets. Most importantly, they are looking at, even, looking at diesel as a kind of medium for blending, which is not done in India as of now. Some R&D work is still going on. So this is like a futuristic kind of technology company where which is very rare to find in Indian capital markets, and all these things may not get factored into the earnings of this company as at this point of time. Normally what mistake investors do is they only look at the current year's earnings and the 1 year forward earnings. But these kind of projects which the company is working is going to give them a very strong runway for growth over the next, say, 3 to 5 years. So I think, if you want to buy this stock, I think take a 2 to 3 year time frame. And recently, the stock was available at 300 rupees again, in the revival in the markets a couple of days back. The stock again moved up based on the quarter 4 numbers and the market sentiment. But any correction here, my sense is one should definitely look at it as a very strong wealth creating opportunity, because over the next 2 to 3 years, the profile of the products and the profile of the revenue, not only from India but abroad, is going to significantly change. So to that point of fact, it's a very strong wealth creating opportunity, but provided one has the next 2 to 3 years in mind, because many more things and many more technology savvy kind of products are going to be launched, which unfortunately, some of the competitors would be able to make. And that is the key differentiating factor for Praj. Like, you may not find a similar company like Praj in the capital market for a very long time.
Yeah, right.
Actually, I have one follow. Hello, Avinash, can we any view you have on Balrampur, since we were talking about ethanol? Say this companies which were doing buyback every year, their equity has reduced some 20% in last 4 5 years. Plus, their whatever I remember from their earning projectile, now 50% of EBITDA is generated from ethanol business, than rather than 50% is only which is coming from cane side. So the stability of the earning, which will help in terms of re-rating, plus their capacity expansion, I guess this year 2x in ethanol side. So any view on Balrampur especially?
No, I think, Ravi, your point is right. They have made the business more, stronger, and they have de-risked their business as far as the sugar cane business, which was traditionally run. Today, ethanol is going to be a massive kind of earnings growth driver for them. And I think if you look at this company over the next, say, 2 to 3 years, then I think clearly it seems to have a very strong runway for growth going forward. Most importantly, it has shown some sort of, shareholder rewarding kind of approach by going in for a buyback. And that has not only helped the company, generate a strong earnings growth trajectory, but even improve their operating metrics numbers like return on equity, their ROC. So my sense is, I think markets will definitely take a kind of a positive kind of liking for the stock sooner or later. I think this is also one stock which got corrected significantly, when recently government announced the imposition of a export quota for sugar companies. The management came on television, I mean, on some electronic business channel, and clearly said that, this is something which is not so significant and is not going to impact the profitability badly. So I think markets were definitely jittery, but I think thereafter, I think, markets realized that the management was on a sound footing, and I think there was a logical answer to, the kind of price fall which was, generated in the market. So I think these kind of companies, Ravi, the only thing is one has to stay invested for a longer period of time, because the ethanol story, has been played out now for a very long time. People have realized that it's something which is the same stuff which is being spoken by investors. But if you look at the earnings growth trajectory, these companies are likely to surprise significantly on the upside, and that is something which the market will obviously reward by giving them better valuations. And obviously, sugar companies are, classic cyclical companies. The ethanol business, I believe, is going to be more of a secular kind of growth business opportunity, and which will obviously manage to give the companies a decent kind of valuation. So I think net Balrampur Chini also looks good. There's no doubt, but overall, I would believe that, it's only a matter of time before we see those valuations come back and get reflected in the stock price.
Sure, sure. Yeah. AI, you can
AI,
go.
you can go. Yeah. Yeah, Vinesh, I would request your opinion on Piramal PEL if you have any outlook, or I mean the pharma and the NBFC space.
Yeah, I think my guess is that Piramal Enterprises will see a lot of value unlocking going forward. First is the pharma business. The management has gone on record saying that at the right valuation, they would demerge the entity. And I think, it would present a very special situation kind of opportunity when it is announced, because we have seen in the past that nowadays in the market, what actually works also well with investors is special situation kind of stocks where possibly a merger or a demerger is announced. And I mean, once the demerger is finalized, and the terms of the share distribution ratio is finalized, I think pharma business is something which will be definitely be looked very closely. As far as the real estate parcel is concerned, as far as the NBFC business parcel is concerned, I think these are also pockets of opportunity. The real estate business is also turning around. We are seeing a lot of interest, coming back in the real estate space. So my sense is, yes, I think they are well positioned, but as a consolidated entity, I would believe that markets, whatever valuation has been given to them, they will wait for these trigger points to unfold, like the pharma business getting demerged, or maybe the real estate parcel, or maybe the financial business, hived off as a separate entity. Once these initiatives are announced, I think then you could see a significant amount of re-rating, and I think markets are well aware that at the right time the management will announce this. So I think one has to be a little patient here, but definitely some good news should come in, and I think investors should stay invested here.
Yeah, thanks, Avinash. So we have one speaker request with us. DV, you can unmute and ask your question, please.
Hello, am I audible?
Yeah.
So I wanted to ask about the pharma space. So what are the new themes in the pharma space, especially if crimes area? I was studying about Syngene. So is it a good stock? And any other new trends in the pharma space? Yeah.
I think my guess is that CRAMS is a well established opportunity, then CDMO is a new opportunity. My guess is that within the pharma space, I think I would be also be keen to look at hospital companies. If you're looking at companies which have recently generated quarter four numbers, Fortis has been one company where the numbers have been very, very robust, very strong. And most importantly, as an integrated package, this hospital company has done remarkably well. In fact, although these businesses are very capital intensive, uh, this company, that is Fortis, has generated a very good operating cash flow, a very good revenue growth. Most importantly, now all the pieces of the puzzle seem to be coming off very beautifully. And my sense is that even at the current levels, pure hospital companies also could remain in focus. I think other players which are doing a good job are players like Narayana Rudale, or for that reason, this Fortis Healthcare. Apollo Hospitals also is definitely a frontline player here, but I think the fourth quarter numbers which came out was slightly disappointing. They have also said that they want to get into the digital online medicine space, which obviously is going to be another growth trigger for them. So my guess is that if you're talking about companies like Syngene, these are companies which are basically companies which work at the back end of many pharma companies. And most importantly, in the short term, one may not see a kind of an earnings explosion in these companies, but longer term, I think the opportunity for R&D, the contract research in India is immense, considering that the arbitrage in India as well as developing countries is significant. So I think Syngene will definitely continue to grow and say enjoy a very strong parentage of Biocon, which has a very rich heritage of very new molecule which company develops from a time to time basis. So clearly, if you're looking at the next 2 to 3 years, then I think Syngene can definitely be a very good, wealth promising opportunity, because this is not a space where client relationships are developed overnight. It takes a lot of time before clients are very comfortable in sharing their modules or sharing their products with the with such kind of contract research companies. So I think the stickiness of that clientele, the stickiness of that business is very important. Unfortunately, in the markets, what all of us see is immediate benefits in terms of quarterly top line, quarterly profit, which may not be the case of Syngene. But if you look at the next 2 to 3 years, definitely, I think this is one space which has got a significant leg up to grow. I think companies like DVs, or for that reason, Dishman Carbogen, which is also into the contract research opportunities, are also good companies. But I think overall, this space is definitely bound to grow. And I think looking at the labor arbitrage which India offers, I think this is one space where I would like to say that one should look at companies which have got a decent exposure in CDMO or maybe contract research, because these are opportunities where the margin expansion and the margin outlook continues to be quite positive, unlike traditional companies, which are in the generics or maybe in the non-generic space, where margins are definitely, to a large extent, sometimes, regulated, by the respective government agencies. So I think this is one space where one can definitely look at it from a long-term point of
Divi, I hope this answered your question.
Yeah.
Thanks, thanks.
Thank you for
So
answering.
we have Pradeep ji with us. Pradeep ji, kindly unmute yourself and ask your question, please.
Thank you, sir. Avinash, sir, during this recent correction, energy sector has outperformed. Which stock you think are better placed during in the energy sector? And what is your opinion about NHPC specifically?
Yeah, I think NHPC also will do well because in hydropower, also there's a massive opportunity. And in a country like India, hydropower is a naturally generated kind of source for power generation. But unfortunately, NHPC has never given the kind of shareholder returns it has in the last 10 years. If you see the last 10-year data point, you will find that NHPC has never created wealth for the shareholder. So, that is something which is definitely not something which has been liked by the markets. Frankly, in today's scenario, what most of the market participants are liking are companies like Tata Power, which have announced very aggressive plans in electric vehicle infrastructure, solar, renewable. Another company which is NTPC is also I would believe is a better more candidate than NHPC, considering the fact that a large part of its generating capacity now, some incremental capex which has happened is going to get executed in FY23. So I would believe that rather than NHPC, it would be a better choice if you look at companies like Tata Power or maybe NTPC, and obviously power distribution setup like even REC. REC, the company generates a very steady cash flow and a very profitable power financing business. They paid a dividend of almost 15 rupees on earnings of almost 50 rupees. So I think not only the growth, but even the dividend yields would definitely look very attractive at these levels. So I think you need to have a combination of such kind of stocks in your portfolio, because power is definitely a sector which is now very geared up for stronger growth in the next 2 to 3 years. And unfortunately or fortunately, what has happened is supply side, dynamics are in favor of the sector. Very little expansion has happened for all these power generating companies, and demand has grown steadily year after year. So that is how the demand supply equation has become favorable for these players. And plus, the government is now very serious in increasing the tariffs of these power companies, which if it happens, it definitely adds a lot of sheen and a lot of focus and a lot of focus drive on their cash flows, because tariffs getting increased is something which had not happened for so many years. So to that extent, I think the tailwinds for this sector are quite positive. So I think you can look at all these companies, and I think you can possibly do a small SIP in these companies if you've got a 2 to 3 year kind of time.
Okay, thank you, sir.
So, Avinash, we just talked about renewable sector. So, the targets being set by the government, how realistic you think are those achievable, or it's more of a narrative thing?
No, I think, see, first of all, in renewable, the bigger players are going to be players like Reliance, the players like Adani. So, in terms of execution, I think my sense is that both these groups are very aggressive on execution. So, whatever capacities they have planned, I think they would definitely execute it on a timely basis. The key question is that what is the kind of support they get from government, because renewable energy on its own will not be able to survive. You require a lot of incentives by the government. You require a lot of support from the government, and to that extent how the government actually executes these kind of things is going to be very critical, because see, as of now, most of the green energy companies like Adani Green, or for that reason companies like typically even Tata Power, or for that reason the company which Reliance took over, I forget the name of that company, if you could help me, which was a standalone business, but then it was Sterling and Wilson, sorry, yeah, so Sterling and Wilson. Now, all these companies have a large business opportunity. But if you were to ask me whether these companies are rightly valued, I would believe that valuations have gone past basically the fair value, because markets have taken green energy to a very high record level. So making money in these companies would obviously depend on the kind of entry points which investors make, because this is a business which is not going to be secular. It is going to see lumpy growth. In one quarter it can be good, in the next quarter it can be bad. So next 2 to 3 years definitely look good, but from a near-term perspective, some challenges will continue to remain. So I'm pretty sure about the execution side. I mean, how government responds to the kind of incentives and concessions which these guys would require to be sustainable is something which is very important, because clearly green energy is something which unfortunately the solar energy is something which cannot be stored, and obviously it has to be consumed also equally fast. So there are many do's and don'ts and pluses and minuses in this sector, which I think individually, one will require a little more time to understand, which is the best company. Adani Green, if you see the way the stock has multiplied in the last 2 years, unbelievable returns and virtually no correlation to the fundamentals.
Yeah, rightly said. So, Avinash, we were discussing about the platform companies. So, say for example, IEX. So, how I mean, the how you see on the part of entry barriers to such platform companies. I mean,
Yeah, I think as far as IEX is concerned, I think after the bonus issue, the stock has come under pressure. But my sense is that this is a business which is a very scalable business. It's a product, a platform company, so basically a very asset light business. And I think one must understand that despite the fact that two new, power exchange companies have been announced by the government, it would take a long time before we could see them happening, getting implemented and coming into the market because see, frankly, it's not an easy proposition to float a company to get new customers. IEX has done a lot of work, and in fact, IEX has gone one step forward. They've actually started a gas exchange, and I think the benefits of that gas exchange volume are going to get reflected in FY23 quite significantly, because gas also is a very large kind of a product which is traded, and obviously on an exchange like IEX, it gets more of a accurate value. The execution time is also very less, so my sense is, this is a very steady business. But the negative is that, hopefully, if the government does not put some regulation on the pricing side of the power trading commission or maybe the power trading kind of charges, then I think it could possibly lead to a little bit of uncertainty for this kind of business. At least as of now, these discussions are not yet finally, approved, and these discussions are yet being suggested whether some ceiling has to be put on power trading kind of companies. That would definitely be like a dampener, at least in the short term. But definitely core demand is growing, and core demand is obviously going to benefit the distribution companies, especially platform companies, because finally this is one medium where the scalability is very large. In fact, in India, hardly 10-15% of the power generated gets traded on these power trading platforms, so there's a lot of headroom to grow. Only thing is, I think in the very short term, these kind of challenges would continue, but in the longer term, I would believe that a lot of money can still be made from a company like IEX.
yeah, thanks. So one last question from me, Avinash, and then we have already taken 2 hours, and it was like really insightful on your part. We didn't feel like we have been listening incessantly from last 2 hours. So guys, humble request: kindly check the handle of Avinash sir. He has been doing great work for the retail investors. Kindly check his handle and do show your love. Do connect with the handles of the panelists so that you people are notified as and when we hold such educational spaces in future, and also various outlook about different sectors and scripts have been shared on these handles. So I request to kindly follow our handles. So the supply constraint which we are seeing, so how long this supply demand mismatch is going to stabilize? I mean, your view on that, sir.
So supply demand mismatch for what in particular, please?
I mean, if we say UK, Russia, Ukraine, Russia war is creating the commodity, I mean, supply side issues. So on that aspect, I'm asking.
Yeah, I think nobody expected the Russia-Ukraine war to continue for the third month, and now we are slowly approaching the fourth month. My sense is that it's very difficult to pinpoint when the Russia-Ukraine war will get over, but this is going to be a major trigger point. Like the day the war is culminated and gets over, you could possibly see a steep correction in crude oil prices, in commodity prices, and I think things would gradually get normalized. But I think till that time, I think it's going to be a key challenge because, as everyone is aware, US has imposed severe sanctions on Russia, and I think, as I was telling earlier in my discussion, that one major issue which a lot of people have not discounted is the food grain crisis. Globally, food grains crisis is going to be a very big issue, and since Ukraine as well as Russia are into very key raw materials and commodities, it is very clear that companies which obviously are into the food grain business in facilitating the food grain production would definitely do well. But as far as the supply side dynamics are concerned, I would believe that maybe we are yet at least a couple of months away before we could see these supply side pressures, especially for crude or commodity prices or natural gas prices, to cool off. And I think crude is yet showing a hardening trend, which clearly shows that on ground things have not changed that significantly as what has been reported in media. So I think till that time, it's going to be a very, very fluctuating as well as a very volatile period. My sense is that possibly by end of July, or maybe early July, mid July, I think we could see maybe this face off between Russia Ukraine getting over, and that point of time the market should obviously look at it very positively, because at that point a lot of uncertainty which is prevailing in the market would come down. The rupee factor would, the US dollar factor, the crude oil factor, commodity prices factor, all these things would obviously tend to fall back, and that definitely would have a soothing impact on the markets, at least in India. And I think globally also markets would cheer this event, because this is definitely something which is not good. As long as the war continues, the markets would remain volatile and uncertain.
Yeah, thanks, Avinash. So, Avinash, thank you so much for today's session. And I would request closing remarks from your side, and also request you to, give a message to the retail investors who have just started, the basic thing you want to say. And after that, we can wrap up today's space. It was really insightful.
Yeah, I think as far as the retail investors are concerned, the guys who have entered the markets a couple of years back, I would, encourage young, investors to actually allocate a decent amount of money for basically wealth creation in a very steady and a very disciplined, process-oriented manner. In the last 2 years, we have seen a lot of Robinhood investors who have made quick money in no time. But I think going forward, equity is always a long-term asset class which has outperformed all other asset classes. So I think, if you have a limited capital, also please start an SIP. Either if you want to do a direct investment in equities, or you want to start a mutual fund, or you want to buy a index fund, but definitely don't stay away from equity markets. Don't stay away from financials markets, because this is one market which is going to generate a significant amount of alpha in the longer term. In the next 5 to 10 years, we can definitely, all of us can become financially independent, generate a lot of wealth, provided one follows a proper system and process in place. And please don't get lured by people who are there in the markets. I think, without naming anybody, there are many people who are there on Twitter, who are there on WhatsApp groups, Telegram channels, who put a lot of unsolicited fake data to promote their companies products and services. So I think please don't get carried away by these kind of people in the market, because unfortunately, there is nobody in the market who actually guides investors as to what is right and what is wrong. So, I mean, this is something which I think all of us should do their personal hygiene, once they want to, proceed on their investment or financial kind of journey. Because today, unfortunately, people get carried away by these short-term kind of, inputs which come in the markets from various people, and that obviously leads them to, believe that everything is possible in the short term. I mean, I would like to repeat my point which I made earlier, that money making is not easy. It is a very difficult process, but it is very much achievable for all of us, for all the retail participants, if you follow a proper process, and which will lead to good amount of wealth generation for all you guys in future.
So true, Avinash. Every word we can echo. I mean, last see those who entered the market in bull phase are living in oblivion that they have earned money by, hard work, but they forgot the luck factor and the bull market effect. So, guys, as very rightly said by Avinash ji, you have to be very cautious. You have to learn the nuances of market, and the fundamentals of market are very important. And those who are new to market, they should try to learn the fundamentals and basics of market. If they can spare time and are intelligent enough to do it on their own, they are more welcome. And if they want to get mentoring on this, they can contact Avinash ji through his Twitter handle. And I can bet, like, with today's session, you people are aware, you people have stick to this spaces for last 2 hours, so that is very, the interest, your interest is conspicuous. So I would request each and every one of you to be, if you are investing your hard earned money, it should not be invested in anything, or you should not be soliciting any kind of tips over social media. So it would be wise on your part to learn the nuances of market from learned people, so that you at least get a basic idea of avoiding the don'ts of market, right? A market is, if you are in market, it is a never ending learning process. But again, those who have seen considerable time in the market, they have seen cycles, they have seen how the economies, I mean economic cycles, credit cycles behave. So there are so many aspects to it. So those who want to learn these nuances may contact Avinash ji. And apart from this, I would sincerely thank each and every audiences who have stayed with us for more than 2 hours. And it was really kind of you people to shower love by connecting to our handles, and it was very generous of Avinash ji taking all our questions so humbly, and he explained it no better manner other person can do. So it was really nice hosting Avinash ji, and I hope we can have such future associations as well, so that more and more retail people are getting benefited with the huge experience you carry. Thank you, Avinash ji.